There used to be a very simple path for investors to participate in the growth of generational companies. The same companies that went on to define entire industries came to public markets early enough that the average investor could buy them and participate in the company's rise to the top of the market cap rankings. Microsoft went public in 1986 at about a $500 million valuation, Amazon in 1997 at roughly $440 million, Google in 2004 at around $23 billion. Those companies went public while the majority of their growth was still ahead of them. If you had bought and held, you captured gargantuan upside. That is no longer how things have been playing out. The companies shaping the next several decades are staying private far longer, and they're reaching enormous scale before public investors ever get a chance to own them. SpaceX is the clearest example. It recently IPO'd at a valuation of $1.75 trillion. By the time public market investors were able to buy shares, the company was already one of the most valuable businesses in the world. Private equity and venture capital firms were able to participate in the entire run from the start all the way to this massive public IPO. Public investors had no such chance to participate. OpenAI is another great example. They recently raised capital at a valuation in excess of $800 billion. They have tens of billions in revenue and a product that is already embedded across 800 million monthly active users. Public market investors completely missed out on the ability to participate in one of the biggest companies of all time. Across just those examples, you're looking at trillions of dollars in value that was created entirely in private markets. The public never had access to the phase where the company went from a business with early traction to a household name. That phase used to happen in public markets, but lately this has become less and less true. The underlying reason is that companies no longer need public markets to fund their growth. In prior decades, going public was often a requirement because the capital needed to scale simply wasn't available anywhere else. Today, that capital exists in massive private pools. Venture capital, growth equity, wealth funds, and other large institutions can write checks at a size that used to require an IPO. When a company can raise tens of billions of dollars privately, it can keep growing without taking on the regulatory burden and short-term pressure that comes along with being public. And that naturally pushes the IPO out further and further. There are also real advantages to staying private. Founders retain control. They can make long-term decisions without managing to quarterly expectations. They can invest aggressively, change direction, or absorb short-term losses without the stock market reacting in real time. That flexibility matters when you're building something that may take a decade and more to fully play out. The result is a shift in where value gets created. The number of publicly listed companies in the United States has declined meaningfully over the last few decades, while the private market has expanded. More of the economy's growth is happening before companies reach public markets. If your portfolio is entirely public equities, you may be losing out on exposure to some of the world's leading businesses. That does not mean public markets are broken, or that you can't build significant wealth owning solely publicly traded stocks. It means that a portion of the growth that used to be available to public investors is now happening in a part of the market most people do not have access to. There are ways for individuals to access private companies. Secondary platforms facilitate transactions when early investors or employees want liquidity. Private funds pool capital to buy pre-IPO shares. There are structures that allow people to get exposure, but they come with trade-offs that people need to understand. Access is not equal across all participants. The most attractive opportunities tend to get allocated to the largest and most connected investors first. By the time shares are widely available on secondary platforms, it's a reasonable thing to do to ask, why are these shares available to me, and who passed on them before they reached me? Information is limited. Public companies report consistent quarterly earnings, and their pricing constantly reflects market feedback. Private companies disclose selectively, and valuations are set in discrete funding rounds that may not reflect where shares would actually trade in an open market. Liquidity is also constrained. If you invest in a private company or a private fund, your capital is often locked up for years. There's no guarantee that you can exit when you want to. Fees are higher. Private structures frequently include management fees and performance-based compensation that can meaningfully impact net returns. None of that makes private markets inherently good or bad. It means they require a higher level of diligence and a different underwriting process than public market investments. The more important question is how private investments fit into a portfolio. If the most consequential companies are being built and scaled in private markets, then a portfolio with zero exposure to that segment is making an implicit bet whether they mean to or not. It is assuming that public markets alone will capture the majority of the value that matters going forward. That assumption made more sense when companies went public early. It is less clear in a world where companies approach public markets after they're already so dominant. You can still build wealth in public markets. You can still own great businesses and compound capital over time meaningfully. The question is whether a portfolio that excludes private markets entirely is missing a segment of the economy that has become too large to ignore. At Valorum, we help clients think through how private markets fit into a broader portfolio, including what to own, what to avoid, and how to access opportunities responsibly. If you want to understand whether this part of the market should play a role in your portfolio, book a call below.